What's up, stock compounders? Brad here. So today, an interview with Jeremy Grantham. Okay, this was just released this morning. Bloomberg interview with Eric Schatzker. These two actually did an interview a year ago, okay, where Jeremy Grantham was calling a bubble. Now he's calling a super bubble 1 year later. A year ago, Grantham said, when you have reached this level of obvious super enthusiasm, the bubble has always, without exception, broken in the next few months, not a few years. Okay, so that was a year ago. The S&P is up 27% since then, at least at the time that this was recorded. And he's asked about this by Eric in this interview. Were you wrong when you shared what you shared a year ago? Now, Grantham wasn't ready to own up to being wrong about that. Um, because from his perspective, he's just looking at trends, right? He's looking at patterns throughout history. When we have these circumstances, this is what happens. This is what has happened every time in the past. Clearly, the last year has deviated from that pattern of history. But Jeremy Grantham is now doubling down, okay, calling a super bubble, not just a bubble. He says US stocks are in a super bubble only the fourth of the past century. Super bubbles can really wipe you out. Like in 1929, that's where we are now. So this isn't, a typical bubble where maybe the market falls 30, 40, 50%. This is the big kahuna, okay? So, it's kind of scary listening to what Jeremy Grantham is, the drum he's beating throughout this interview. He talks about, there's kind of a nuance here. In the last year, the S&P is up 23%. The Russell 2000 is down, okay? So I guess that's a fairly unique situation. The Russell 2000 being, I think, like the 1,001 largest company to like the 3,000 largest company, kind of those 2,000 in that size range, that are, negative over the last 12 months, compared to the S&P, which is up a pretty healthy amount, really led by the FANG stocks. The Russell 2000 is meant to go up about 1.2 times the market in a bull market. Okay. I don't know what meant to means. Maybe that's just been, historically what has happened with the Russell 2000. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000, the dot-com bubble. I'm clearly more certain now about a bubble than I was a year ago, is what Grantham says. The hallmark of a bubble, crazy behavior, right? What would you point to right now? This is what Eric is asking Jeremy. What is the crazy behavior that's really, the hallmark of this bubble? I think the peak of crazy behavior is behind us, okay? He didn't really get into what that was. Crypto, meme stocks, all the short, all the things that we're familiar with from 2021. Now we're in buy the dip mode. Okay, that seems to be the mantra of every fund manager, every investor, because the psychology is still coming from a place of bull market. Okay, it's much more greed oriented, to kind of don't miss out, as opposed to fear oriented. So every drop, we think, okay, this is the dip. I got to get back in because I don't want to miss out on the huge run that's going to happen right after this dip. So that's interesting. A little market psychology there. He says you typically don't have 2 years of buying frenzy dying overnight. And that kind of supports this whole buy the dip mantra. Investors now, we think things are going to go up, right? So if they go down a little bit, that's an opportunity. Even in 1929, there were some magnificent rallies, okay? So same kind of mindset in 29, buy the dip. And that actually, propelled some rallies until ultimately, what transpired. The commercial imperative to stay bullish is overwhelming. Okay, uh, hedge funds, fund managers don't want to throw in the towel. Okay, they don't want to get out. Their paycheck, their livelihood, really depends on the markets, going up, money coming in, right? This whole bullish party. That's really the commercial imperative. Now he talks about the trend line for the S&P 500, and being slightly generous is 2,500 for the S&P right now. So if you look at sort of a max view, click max here for the S&P 500, it goes back to 1982. Okay, so 40 years of the S&P 500 is covered here. If you make a trend line through this, Grantham is saying you end up right about here, okay? 2,500, where we should be in the beginning of 2022. Most super bubbles go below trend and stay there for quite a while, okay? So assuming we're in a super bubble, right? The way that Grantham is defining it's based on numbers, okay? It's a 3 sigma deviation from the trend of the S&P 500 is where we are. So most super bubbles, right, go below trend. So the trend is 2,500. So, if this super bubble does in fact pop, Grantham thinks we're likely to drop below 2,500 for the S&P. Now, from where we are today, that'd be a 43% drop, okay, to get back to trend. The Fed was able to stop the dot-com crash at the trend line, okay? So I guess that's here, right on trend, here around, $900 or so was I guess on trend, and that looks about right. The Fed was able to stop the dot-com crash at the trend line by implementing certain measures. So that was a 50% drop, okay, which even though in 2000 we were in super bubble territory, the crash was only a bubble type crash, 50%. Could have been much worse given the super bubble status. Even with intervention, it will be hard to prevent the S&P from declining to 2,500. Okay, so Grantham thinks it's inevitable. We're gonna go down to 2,500, perhaps even less, when this super bubble pops. He says, I think investors will do pretty well to sell out of the U.S. Okay, you don't hear a lot of fund managers talking like that. Okay, so Grantham thinks it's probably wise to get out of U.S. stocks. He says everywhere is less overpriced than the U.S. The U.S. will decline a whole lot more than the rest. This is really interesting because I just saw a talk, I think it was last month with Bill Miller, who basically said he thinks the market is fairly valued, right, given where interest rates are. So it's interesting to hear such a discrepancy between two well-established value investors in Grantham and Miller. It's quite fascinating. Grantham goes on to say value stocks outside of the U.S. That's really where he thinks, what he thinks is the most likely area to do well over time from where we are today, particularly emerging markets, also Japan and the UK. The U.S. is shockingly overpriced, is how Grantham puts that. He's asked if he's shorting anything, given that everything is so overpriced. Has Grantham gone short in anything? Personally, I am short a decent amount of Russell 2000. Okay. In terms of quantity, he's short about half as much in the NASDAQ. NASDAQ is tougher to short because it includes the FANGs. And, you know, it's a pretty risky time to bet against the FANGs. He says if we weren't exposed to a large amount of growth stocks in venture capital, we would skip the shorting. Okay, so the shorting is really just a hedge for the venture capital portfolio. In 1929, so this is talking about his potential suggestion to consider getting out of U.S. equities. In 1929, you didn't get back to even until 1954. Okay, so it took 25 years for the market just to get back to the level that it was in 1929. That is a scary proposition. In 2000, you didn't get back to even for 13 years. Okay, in Japan, they are still not back to the 1989 peak. Right? What is that? 33 years later. So you know these super bubble crashes can cause a lot of pain, and it can take quite a long time to even get back. In this case, to where we are today with the S&P 500. So he describes what his measure of success is. We have a relatively humble measure of success, and that is at some future date, if you get out when I said get out, you will be glad. It doesn't mean you won't suffer in the meantime, okay? And he talks about Japan. He says, it worked in Japan even though we were early. It was smart to get out when Grantham got out of Japan. In 2000, they eased up in U.S. equities in mid-1998, right? You can imagine pulling out of U.S. equities in 98 and just watching that whole dot-com run. That would be painful, right, to miss out on all that. But if you got out in 1998, it was much lower than that in 2002. Okay, so would have been very difficult, but you actually would have been better off to wait until all of that passed. Of course, you would have had to know, 2002, that's when I'm supposed to get back in, right? And not bought a false dip along the way during that, 3-year drop during that dot-com boom crash. So, it's some of this stuff is obviously much easier in hindsight, but it sounds like the track record of Grantham getting out of bubbles, it seems like, he's probably done better in that regard than if he had just kept everything in. So there's a little bit of market timing intelligence here. But he really waits for extreme signals before he acts on any of this market timing stuff. What is a bubble? A standard bubble is a 2 sigma statistical event. It's just a measure of how much an outlier you are. It's a deviation from the trend. So a 2 sigma should occur every 44 years. Don't know what that's based on. But it actually occurs every 35 years. Okay, so 9 years sooner. Because we're wilder and less efficient than we should be, us humans, right? It's because of this fear and greed where we overshoot on both ends. I guess it would be overshooting on the bullish end. The 3 sigma should occur every 100 years. Okay, so instead of 44 years, every 100 years. These actually occur 2 to 3 times more often than they should. Okay, so with respect to the 2 sigma events, they occur much more often than they should, according to the statistics. Super bubbles can really wipe you out like 1929 did, and that's where we are now. We entered a few months ago into 3 sigma territory. Last year, we also entered bubbles in real estate. So this is really the setup that Grantham is particularly concerned about. You've got the super bubble in U.S. equities. We also have a bubble in real estate, okay? He also mentions we have overpriced commodities. We have the lowest real rates, interest rates, in the history of man. And it's not just a U.S. real estate bubble. We have a global real estate bubble, okay, and a U.S. stock market super bubble. So where is money to go when everything is inflated in this current environment? And that's quite a setup. That's a setup for some very interesting times ahead, according to Jeremy Grantham. How worried are you about inflation? Jeremy is asked. I haven't written about inflation for 20 years, he says. It is now on the radar screen. Okay, so really for the first time in the last couple of decades. We're in the early stages of running out of raw materials. There's only a certain amount of cheap oil, cheap nickel, cheap copper. We're beginning to hit some of those boundaries. So in a world with finite resources, we're kind of coming up against some, supply issues here. We're going to have bottlenecks everywhere. The food price index of the UN is about as high as it gets. Growing food is getting harder to do because of climate change, right? You've got this unpredictable weather. Places are getting wetter. They're also getting drier. They're getting windier, stiller, hotter, colder. There's this destabilization that's happening with the climate that's making it more difficult to grow annual crops being, not very resilient, right? They don't have very deep root systems. These are kind of fragile plants. I mean, certainly not as much as they used to be. Corn and soybeans, they've really been engineered, but it's a very delicate system. These huge monocultures, right? These cornfields that are hundreds, thousands of acres large. It doesn't take big climate events to really throw a wrench in food production. Let's see. We're going to live in a world of bottlenecks and shortages and price spikes. Okay, this is a scary picture that Jeremy Grantham is painting here. Commodities have a long history of doing quite well when inflation picks up, and inflation is quite likely to pick up, according to Jeremy. It is pretty clear that we are running out of labor. So this is where he kind of gets into fertility, human fertility. There's been some disturbing trends towards infertility with humanity. Fertility rates have dropped like a stone. He talks a little bit more about that later. That's where he's talking about the labor, right? Generational labor. So maybe not right around the corner, but this generation of 20s, 30-year-olds having a lot more difficult time getting pregnant, reproducing. Okay, and I'll talk a little bit about why Jeremy thinks that is. I think the Fed absolutely does not get the pain that's involved with the bubble breaking. I guess Jeremy Grantham thinks the Fed is being a little bit cavalier with their policies. You can see that in the history of the last 50 years, that they don't really understand. They're not taking it seriously enough, is kind of me reading between the lines. If we do not address rising inequality, we will be in real trouble. We are the least equal society in the developed world. We have the least fluid economic mobility. And I wasn't sure what that is. He went on to kind of go into that a little bit. The number of people moving from the bottom quarter, I'm guessing this is wealth, to the top quarter in a lifetime. That's not happening very much in the U.S., where that those strata of wealth are largely kind of fixed in a sense, as compared to other developed countries. And that speaks to the inequality. It speaks to kind of systemic structures in the U.S. that make it difficult to break out of these kind of low income tranches, so to speak. Let's see. Will blockchain turn out to be useful? So he's asked about crypto in the last part of this. It seems like that's the trend in every interview these days, to save the last quarter or fifth of the interview to talk about crypto. Will blockchain turn out to be very useful? Grantham thinks absolutely, yes. Does this justify trillions of dollars of perceived wealth? No. And I appreciated this perspective. The internet has created enormous value, but it didn't make the builders of the internet, there weren't any owners of the internet that got incredibly wealthy because of the success of the internet. And Grantham thinks that's something people are missing about crypto. He thinks crypto is going to be an incredible enabling technology, to cut out middlemen, to kind of make everything more democratic. Democratic probably isn't the right word. To reward the creators, right? To cut out the middlemen, essentially. So it's going to be an incredible enabling technology. That doesn't mean it's going to be a capital amassing technology, right? It doesn't mean you're going to be able to get rich through the technology by investing directly, by owning a piece of the technology. Okay, I think that's that makes a lot of sense to me. I think that's something that maybe people aren't quite seeing about this crypto boom. He's asked about green. So Grantham is known for his kind of investing around climate change, green investing. So Eric asks him, green, are there any other trends that you're kind of investing behind other than the green movement? He says the green will turn out to just be a subset of a bigger, more comprehensive issue, and that is living within our means. Okay, this is really a value investing kind of core principle. Live within your means, generate a surplus, earn more than you spend, and then put that surplus into a compound growth engine that is a stock portfolio or whatever you want to invest in. We have simply shot way beyond the long-term capacity of the planet to deal with us. Okay? One of the problems is waste. He talks about plastics. Plastics, it's this lingering kind of toxic material that nature doesn't know how to break down. Okay, it's become a pollutant. It's not just climate change and greenhouse gases. We have toxic chemicals, right? That air and water are nature's greatest solvents. Okay, so you can't spit some toxic chemical into a body of water somewhere or into the air and expect it to just go away, right? It's actually going to get swirled around the entire world, okay? And it just grows and grows and grows. So there's a strong indication that the planet is really not conducive to life, and this is kind of where he gets back into the whole fertility issue. We're killing off our insect life, all manner of animal life. The world can do just fine without us, Homo sapiens, but it can't deal without insects because of a cascade effect. Insects are really the bottom of the food chain. Well, plants would be below insects, but there's so many animals that depend on insects in order to keep living, right? And it's this delicate chain, right? This ecology. Insects are a core piece of it. So he says nature is beginning to fail. And in the end, if we don't fix that, we begin to fail as well. And we see that in the toxicity numbers. Human fertility is going to hell. We have 1/3 of the sperm count that we had at the end of World War II. In the last 20 years, we've gone from young couples needing help, a rounding error, needing help with, having babies, from a rounding error to maybe 15% of every young couple in the U.S. now needs help. That's more or less a global problem. So it's not just a problem for young couples in the U.S. It's globally. Fertility issues are becoming more and more of a problem. So the big problem here, beyond climate change, right, which is just a piece of it, is living beyond our means, using up our resources, putting too much pressure on the natural environment, poisoning the natural environment. In that sense, it's a lot bigger issue than climate change. Whew. So there's a lot to chew on there, guys. A lot of, I'd say, tough truths here from Jeremy Grantham in terms of potential big-time crash on par with what we saw in 1929. Given that we also have this global real estate bubble happening concurrently. We've got inequality, right? We've got huge environmental issues. We've got commodities, that are pushing up against the edge of what we can cheaply mine and produce. So there's a lot to consider right now. Not much positive message coming right now from Jeremy Grantham. But one thing I really appreciate about him is he's not trying to sugarcoat anything, clearly. I think it's a heartfelt message here. He's genuinely concerned about all these things. He's not, sounding the alarm because he's got some hedged position on that he's trying to profit from. I won't name names of people who have taken that approach recently. But, it seems like he's just, he's coming into the kind of last stages of his life. He's amassed an incredible amount of wisdom over his career, over his lifetime, and he's calling it like he sees it. So I'm very grateful that he was so transparent and direct in this interview, even though there's a lot of tough messages to take in here. So, just wanted to share kind of my highlights here from Grantham's talk. This video might be longer than Grantham's actual talk, but hopefully you guys find some value in it. I am not taking his advice in terms of clearing out of U.S. equities right now. It's just so hard to time these things, as Jeremy Grantham would be the first to admit. I mean, his prediction a year ago clearly has not transpired. I do plan on investing for, the next 30, 40 years. So, I'm in it for the long haul. I'm not running away from U.S. equities. I'm not going to sell anything because of this interview. But I think Jeremy Grantham has clearly put a lot of thought into this. He's got the data to back a lot of this up. So I found it a very insightful and worthwhile interview. So if you haven't seen it already, go check it out. And let me know what your big takeaways were in the comments. So I will leave it there, guys. Thanks for watching. I will see you in the next one. Take care.